That's number one. What is your time frame? When do you need to move? Because that also influences your interest rate, or it can. Because if you can't move for 60 days, that's fine. Or if you can't close for 60 days, that's fine. We can lock it for that long. But that's a very important question.
There's a moment in so many of life's biggest decisions where you realize that experience doesn't automatically equal understanding. You've done something before, maybe several times, and you think you know how it works until the details shift, the rules change, or the circumstances are different enough that you find yourself with questions you weren't expecting to have. That happened to me. I'm Amy Diaclia, and there's a moment in so many of life's biggest decisions where you realize that experience doesn't automatically equal understanding. My husband and I were buying our fifth home. Fifth. We were not new to this process. Our first two homes were in the same state, so we had a baseline, a sense of how things worked, who the players were, what to expect. Then we moved to a different state, then another. And eventually we found ourselves returning to the state where it all started and discovering that even coming home isn't as simple as it sounds. Regulations evolve, markets shift. What felt familiar had quietly changed, and what I thought I understood about mortgage rates turned out to be more nuanced than I realized. I had questions I wasn't sure I was supposed to have. Questions about rates and cost and what the numbers on the page meant. Questions I might never have thought to ask if I didn't have someone I trusted enough to ask them. These aren't beginner questions, but they don't always have obvious answers, even when you've been through the process before. There's a funny thing that happens the more experience you accumulate. You'd think it would make you more confident asking questions. Often it does the opposite. The more you know, the more aware you become of how much you don't know, and the more foolish it can feel to admit that out loud. Experience can make you less likely to ask, not more. And I know something about asking good questions. I have a doctorate, and I've spent my career in education helping people navigate complex systems, ask hard questions of institutions, and push for clarity where there isn't enough of it. Asking questions, the right questions, in the right order, of the right people, is something I take seriously. But knowing how to ask good questions only gets you so far when the subject matter is outside your own expertise. And that's exactly where having someone you trust makes all the difference. Here's what made the difference for me. My brother has worked as a mortgage broker for more than 20 years. And when I called him with questions, probably more questions than most of his other clients ask, he just answered them. No impatience, no condescension, no making me feel like I should already know this. Just clear, honest, generous explanation of how things work and why. And somewhere in the middle of one of those conversations, I thought, not everyone has this. Not everyone has a brother in the mortgage industry who will just pick up the phone. Not everyone feels safe enough to ask questions they actually have. And some people stumble through major financial decisions, even ones they've made before, wishing later they had pushed a little harder for clarity. Someone had to ask, so I did. And that's what this podcast is. Someone Had to Ask is a show about the questions worth asking before you make a major life decision, and about finding people with real expertise who are willing to answer them honestly. I'm not the expert. I want to be clear about that. I'm the person sitting across from the expert asking on your behalf. And just as importantly, I want to help you understand what questions to ask for yourself. The questions you'll hear on this show aren't just for listening. They're meant to leave you with a framework, a set of questions you can carry into your own decisions, your own closings, your own conversations with experts who may assume you know more than you do. I'm going to ask the questions you might have been hesitant to ask. I'm going to keep asking until the answer makes sense. And I'm going to let the people who know this work illuminate it in a way that makes you feel more prepared, not more confused. We're starting with home buying and mortgage lending because that's where my own questions began. Over the next several episodes, my brother, who has 2 decades of experience in mortgage lending, is going to help us understand how this process works. Not the glossy version, the real version. The one with the rate sheets and the locked rates and the closing costs and the details that surprise people every single time, even people who have done this before. And eventually we'll move beyond mortgages because the need for good questions doesn't stop at the closing table. This need shows up when you're choosing an insurance policy, navigating a legal agreement, making a financial decision, or sitting in any room where someone else has the expertise and you need to understand what they're telling you. You don't need to be a first timer to benefit from asking better questions. You just need someone willing to go first. Someone had to ask, so I did. Which brings me to the person who started all of this. My brother, Jay Sills, has spent more than 20 years in the mortgage industry. As a mortgage loan officer with Barrett Financial Group, he has helped thousands of clients secure financing through conventional FHA, VA, and USDA loan programs. He has built his career on honest guidance, creative financing solutions, and a genuine commitment to making the mortgage process simple and understandable. Jay is passionate about educating homebuyers and empowering consumers with the financial knowledge they need to make confident decisions about one of the biggest investments of their lives. He is exactly the kind of expert this podcast was made for. I called him with questions. He answered every one of them. And today, he's here to do the same for you. Jay, welcome to Someone Had to Ask.
I love I love the whole thing of the interview. Someone had to ask. I think it's perfect.
Well, Jay, I just told our listeners a little about you and about why I started asking questions. What's your memory of those conversations?
Basically, just you were very typical that everybody buying a house is. Even though you had experience, it still feels brand new again because it's easy to forget that you need to provide two pay stubs. You need your W-2s, or do you need to send your tax returns or not? I mean, there's lots to navigate whenever you're buying a house. And really, the good thing about you in your home buying process on your current home was that you did ask a lot of questions. I can't say exactly one that sticks out more than the other. You just had a lot of them, and it was all great questions. I wish everyone asked me the questions that you did. So there's a lot to navigate for sure.
Let's go back to maybe one of the first questions I asked. So, when someone sits down with a mortgage broker and sees multiple rate sheets with different costs, I mean, this is the same mortgage broker, but where do they even begin to make sense of it all?
Okay, so the first thing is whenever you're deciding on a mortgage and what rate to go with, because there's different costs with different rates. So you want to look at, say, what the APR is, okay? And if you're comparing me to another lender, you want to see what the APR is on the program that they're providing you. The APR takes in the whole it combines all the upfront costs throughout the loan. So the lower the APR, the closer the APR is to the actual interest rate that you're paying on per month, the better. Okay. That's a quick way just to see, who has less cost upfront for the rate that they're getting you. Okay. So, but there's a variety of ways you can go. Just because, let's just say, for example, 6%, that doesn't cost, that has the lowest cost, general closing costs, right? But 5.75 could cost 1 point, which is 1%. Okay. Now, that's the another thing that could almost be a whole show on what discount points are, is I think it has a negative attachment to it, and it doesn't. That's not necessarily the case. Everything is so different with every loan scenario, and that's why it's important to talk to your loan officer to get a whole rundown of your situation. Everybody, there's no two loans alike. I've said that for now. I've been in this business for 23 years, but it took me about 3 years to really get it. So for really 20 years, I've been saying there's no two loans that are alike. And where somebody has 6%, somebody with the same exact credit score for their situation, 6.375 might be a better scenario because they would have less cost involved. Now, and at 6%, there could be more cost involved. So I know this gets and that's where everything gets confusing, is what rate to go with and why in the world is there more cost with 6% and there's less cost at 6.375. Here's the answer. It's because lenders can give you a credit. The higher the rate, the more credit we can give towards your title fees. You might not have an origination fee then. You might not have a processing fee. We can give credits for all those things. But if you want the rock bottom rate, which everybody wants the rock bottom rate, lowest cost. What I like to do is give you the rock bottom rate and then give two more scenarios where, let's say, 6%, that's the lowest rate before you start paying points. Those are added fees. And so at 6%, X amount is your closing costs. Let's say closing costs are 7,500. But at 6.25, closing costs could be 4,500 because we can give, a $3,000 credit. Okay. So, or I'll take it a step further and go, or 6.5, and we can give a $5,000 credit towards your closing costs. So now person A can make that decision. Like, okay, I have the means to pay to cover the cost. It's fine. I want the lowest rate because in the long run, the lowest rate will always win every single time. But those other options aren't bad either, just because you're taking a lower or a higher rate. So it depends on the person's scenario, depends about, whether that person needs that $3,000 credit. They could use that $3,000 that they have towards moving instead of financing, a couch or whatever, run up a your credit card with all the moving expenses. Keep that $3,000. You have a little bit of a higher rate that's $50 more a month, but you're not running up a credit card. So that's just a good scenario. That's a very real life scenario that I do every week with someone, just to give the option, because I just feel like I don't want anybody that I talk to have what's called buyer's remorse and feel like, did I really make the right decision? So what I do is I give at least three options and you decide.
And that's what I saw. I saw three rate sheets, and one might have been 6.125. One might, this is some months ago, I can't remember what the rates were then. You probably could. You could rattle them off. But one might have been 6.225, and one might have been 6.275. And
Mhm.
I'm like, why are these different? But your explanation, like it's the cost at the end. And if someone can afford to pay higher closing costs, fine. They might go with that lower rate. Whereas if they want to put more money in their pocket at the closing table, then they might pay
Mhm.
that higher rate. So, I mean, but those are big decisions. And to run through that scenario and what do you have, that cash in hand at the closing table, and that's a whole different episode too. But before
Mhm.
someone even gets to that point, before they're sitting across from a broker, reviewing those rate sheets, what questions should they be asking when they're deciding which mortgage broker to work with?
Okay. I think asking the first question would be, what's the time frame? What am I looking at here? Is this a month long process? 2 months? And because you have to prepare. I think that's number one. What is your time frame? When do you need to move? Because that also influences your interest rate, or it can. Because if you can't move for 60 days, that's fine. Or if you can't close for 60 days, that's fine. We can lock it for that long. But that's a very important question. Is for you, the borrower, the buyer. A realtor recalls call it, it's their buyer, it's my borrower. So I would ask, I would get your time frame in line and just, ask your loan officer, what is a typical timeline for for my loan on, on this house. Um, and of course, what's your interest rate? The number one question is, what's the interest rate? Where are rates right now? And that's the $1 million question. And it totally depends on that particular person. Nobody has the same credit score. Nobody's financial situation is the same. It's just, it all factors in. So that would be another question. What's your interest rate? What's your closing costs? That's what's asked anyway. That's all anybody really knows to ask. But it's not, but it's particular with each person. It really is. Like I said, everybody has different credit scores. If you have an 800 credit score, you're going to get the best deal. It's just that simple. If you're in the 700s, you're still going to get pretty much the best deal. If you're below 700 in the 600s, you can still get a good deal. You're going to be within 0.25% of the person, the 800 credit score person. You're going to be right there. It's not that far off, but the rate is influenced by credit score heavily. So that would be the questions in regards to rate and cost. And then, understanding what all is involved in the loan. Like, what would I need to provide? If I'm going to buy a house, what do I need to provide? Okay. And what that would be is, you need to have your two most recent pay stubs. You need to have your last 2 years W-2s. You need to provide a bank statement, 2 months bank statements from the account you plan on using for down payment or any cost involved. That's the nuts and bolts for any home buyer, is having those items readily available, so your loan officer can calculate your debt to income. Your debt to income determines how much house you can buy. Um, and of course, and down payment obviously influences that, but it's really comes down to debt to income. So, and that's where your loan officer comes in and can relay that information. So, a rule of thumb, as far as if you just want to look at a house and want to see, like, can I afford that house? So the thing to do is to take your gross income. If you're married, take your spouse's and yourself's gross income, and you can go to 50%. That's the pretty much the max. We like to see it at 41 to 43%, but on a mortgage you can go to 50%. Um, so you just want to take your gross income, take 50% of that, and with your bills, and combine that with your mortgage payment, proposed mortgage payment, and that's how we figure it.
So if that's the max, what really? I mean, because I've seen suggestions, or whenever you get on those little calculators online, I mean, oh my goodness, you can afford this, $1 million home or this $700,000 home. Not really. Not really. Not if you're
Yeah.
also paying some tuition for uh, children, or you have bills, or you have HOA, or you're looking at those other community costs. I mean, those can really weigh in, and people forget about that being part of your debt to carry.
And let me add to that, as far as what we look at just what's on your credit report. We're not concerned about your car insurance. We're not concerned about your cell phone bill. We don't look at that at all. We just look at what's on your credit report. So to get an idea of what you can afford is what is showing on that credit report, your car payment, any installment loan, credit card, student loans come into play. Even if your student loans are in deferment, we still take a 0.5% of the balance. So that still comes into play. So you would take your liabilities on credit report, add it to your proposed housing expense, and we did take 50% of your income. And if you're under that, then you can afford it. As far as a mortgage goes, you might not really be able to afford it even at the max, because there are other expenses that we're not even that are coming into play, like your car insurance and other things like that. We're not looking at that. So from a mortgage standpoint, we just look at the liabilities on your credit report to go off of to figure your debt to income.
These are some great questions and great suggestions for people to really think about before they even begin the search for a mortgage broker, begin the search for a house. And when in the timeline would you recommend someone reach out to a mortgage broker, like for you at Barrett Financial Group? When do you want to hear from somebody when they're thinking about a house?
As soon as they think they want to buy a house, the thing to do is to get pre-approved before you even start looking. Before you start getting your heart sold on that $475,000 home, yes, you might be able to afford it, but you need to know. You just need to know, and that's the number one thing. Whenever I speak to someone, I relay that this is the max that you can go to. I'll figure out how much you can go to, and then I love giving three different scenarios. If your max is 475, I'll let you know what your max is. Then I'll back down to say 400,000. Then back it down a little bit more to 350. That way you have a real broad scope of knowing, what you're getting into in that price range. So that's the first question I ask. Just yesterday on a new application, one of the first questions I asked this gentleman was, "What's the price range you're looking at?" Because at first he said, "Oh, we've just been looking at several different homes and that sort of thing." And I said, "Okay, what price are you looking? Because I need to have an idea of where your mind's at. Are you looking at a fixer upper? These days, $150,000 home is a fixer upper almost, and I hate even saying that. You might be able to find one maybe, but not that I see. So I need to know that price range, and that's the number one thing. That's the number one thing for a new home buyer or someone that's already bought a home. You just need to know, how much house you can buy."
Jay, this is exactly the conversation I had in mind when I thought of this podcast. One where the expertise, like yours, is real. The answers are honest, and the listener walks away with something they can use. So if you are leaving this episode with more questions than when you started, that's not a bad thing. That's the point.
Right.
The more you
Mhm.
learn, the more you realize there is to ask. If you listeners found this conversation helpful, share it with someone who is navigating the home buying process or who has done it before and still has questions they never thought to ask. Because we've established today, experience doesn't automatically equal understanding. And sometimes you just need someone to go first. Next time, Jay and I will be talking about a moment a lot of borrowers find themselves in. When a realtor mentions a lender with a little bit lower rate after a broker has already done the work to find the right one. Until then, someone had to ask, so I did.